Spill the Tea. We're here to educate, inspire, and activate. My name's Teresa Barron, and I'm your host. Today, I have a wonderful guest. Her name is Itzia Johnson. But before I get to my guest, let me give you some compliance. I'm a broker in Ohio, and my broker number is 2010002720. Our guest today, let me get to her. She's somebody that I've known for more than a decade. All I can tell you is today we're getting ready to spill the tea on what you need to know when it comes to buying in the real estate market. Listen, this lady is going to give you some phenomenal information. I need you to pay attention. Let me introduce my guest. My guest for today, Miss Itzia Johnson. Welcome to the show.
Thank you, Teresa. It's a pleasure to be here. I appreciate the kindness and having me here today.
Hey, well, we love having you. We love having you, and we're so excited because we know that you are really going to pour in to everyone listening today so that they really get what they need to know. This is a serious topic.
Absolutely.
You know, there's so much to know. And here's the bottom line. Everybody doesn't tell them exactly what they need to know. I want to say this up front. You know, there's levels to this thing. See, and everybody doesn't have that same information. So I need us to really pay attention and to understand what's it going to take. Today we got a problem. We got a problem with housing costs. We got the lowest level in the African American community of home ownership in like 30, 40 years. That doesn't make any sense. We need to figure out how we are going to take care of our situation, our families, our communities. Our goal is to make sure we uplift. And so let's just start with you giving us a little bit of an explanation of how this process starts. So if I bring a buyer to you and I say, Itzia, can you please take a look at this client and let them know exactly what they need to do so that they can begin the journey of home ownership, because that's really where wealth is built in our communities.
Absolutely, Teresa, and I'm glad that you asked that question. The process, like I said before, to all my clients, it's going to be stressful if you don't have the right information. You don't have the right a housing counselor with you. You don't have the right loan officer with you. All of those things matter. So if you bring a client to me, the first thing I'm going to do is just sit down with them. I like to see your financials. I like to see where's your credit report says. All of those things that we need up front. Having that information up front, I know exactly where that you're going to be in the next 3 months.
Yes.
What do we need to do to get you to purchase that home? First, let me have your W-2s. Let me have your pay stub, your bank statements. When you have given me all that information, I'm going to gather all that, put it in your portfolio, we'll say, and then I will pull your credit. Depending on where your credit score is, we may say you may have to wait. Waiting is not a problem. And a lot of people don't want to wait. We're getting patient, right? But waiting is not a problem. So after that information is received, I will pull credit, look at your debt to income ratio, and we're going to talk a little bit more about that. But the process is very simple. Just having the 30 days of pay stub, having your W-2s, and having your bank statements, which we need for access.
So how many, let me just interrupt you, and hopefully just to get into the details. So how many bank statements?
2 months.
Okay. And is there anything about those bank statements? I mean, why do they want to see my bank statements? That's the question.
Well, first we want to make sure that you have capital, that you have the funds available.
So capital is the money, right?
Right, it's the money.
Right.
Then we want to make sure that it's no large deposits. This is what we always get into.
Yeah.
Especially in the Black and brown community.
Yes.
I know in my community, which I'm Hispanic.
Yes.
We don't trust the banking system.
Yeah,
so
girl.
knowing that all our money is underneath the mattress, or we have given to somebody else to hold our money and things like that. So any large deposit that comes through that we cannot source is going to become an issue.
Okay, now when we talk about source, that language, you know, talking about source, like large deposits, when they're sitting in your, we see somebody puts $5,000 into your bank account, or all of a sudden there's a deposit. What does that, I mean, are we saying, are they trying to try to say that where did this money come from? They want to know?
Absolutely, because of compliance and money laundering, things like that.
Yeah, money laundering. That's a big item. Yeah.
Right. So we want to make sure that we have the necessary documentation that we can source those funds. It could be maybe the $5,000 came from your mother. Then that's awesome. Now we just need your mother's bank statement.
To see it came out of her bank account.
To see that it came from her bank account. Now we can do the gift funds because it was a gift given to you.
Right.
So,
Very
once
important.
we have the documentation, it's no issue.
Yes.
It's that when we don't have the documentation, it becomes a problem.
It becomes a problem because to me, it feels like, I'm just telling you, to me, it feels like when they are questioning big deposits, it feels like they're basically calling us dealers, you know,
Right.
or, you know, basically saying, you know, we might be doing something illegal. It almost feels almost like a trap. And I know a lot of people feel that they might be trapped or something, that there might be, might be getting themselves into some trouble.
Right.
But that's not the intention. Is just to be, if we're aware ahead of time, we can make sure. Because how far back are they looking? Like, if the money's been sitting there, they're not going back more than 3 months, right?
Correct. We go 60 days. That's the reason why we ask for 2 months.
Okay.
Of bank statements.
Okay.
So if these funds are being there for the past 6 months, and it's not a big deal, it's seasoned funds. We're not. Yes.
That's another word.
Exactly.
We have to spill some tea. What
Yes.
does it mean when we say seasoned? That is a business, that is a mortgage word. A lot of times they come up with these words and it makes us feel like we don't know what's going on. And a lot of times we don't want to look like we don't understand, so we don't ask questions. So we're going to spill the tea on the word seasoned. So seasoned, go ahead.
Seasoned meaning that the funds has been there for more than 3 months.
There it is. So that's what we really need to know. So we're not going back. If the money's been there for 6 months, we don't care. Those funds are considered seasoned.
Absolutely correct.
Okay. And that's a big deal.
Yes, it
because
is.
nobody's asking questions. So as long as we are operating in timing, like we know in advance, we can season our money. And then if it, came up from underneath the mattress, then it's been there 90 days. Nobody's asking any questions on that.
Correct.
All right.
That is absolutely right.
Now, how difficult, mostly the easiest person to get financing, meaning getting the loan on the house, those folks that are easiest to get those loans, what type of income do they need to have? Like, is it, like, let's say, I'm a plumber and I'm out here, and I'm invoicing folks, but at the end of the day, the IRS lets me write off all my miles. So my money at the end of the day looks different. And I'm not necessarily, I'm paying taxes on the money, but I get to expense out. Are you going to be able to use my income with all, before the income, the money that I actually got? Or am I better off being, working for a plumbing company when I'm trying to buy a house?
That is a great question, Teresa, because what happened, we were talking now about self-employed.
Yeah.
And self-employed can be tricky.
Yeah.
Like you mentioned, you will write off a lot of expenses because of the IRS and
the rules.
The rules. No, we're not going to say the IRS, but the rules exactly, and other things. And it could be actually legit.
Yes.
There are legit expenses that you have. So what you want to do is cut back on those expenses if you know that you're going to purchase a home. Because what we do, we look at that depending on what schedule we're using. First of all, your sole proprietorship, you're going to use the Schedule C.
Yes.
That Schedule C is going to show your gross.
Yes.
And you're going to have your net profit.
Right.
Okay, so that line 31,
the net.
That's the T. The line 31.
There's some T.
Which is the net. That is the amount that we're going to use.
Right.
To calculate your income.
Yes.
2 years of tax returns.
2 years.
And you have to show that your business has increased, because you get a 25% decrease, it can be an issue.
Yes.
So you want to make sure that that income is increasing every year.
Oh, that's so important. That's so important. So those who are self-employed, you know, really just need to have that 2 years of solid business, and they can't just write off so they can get a big refund. What we need to do is make sure that we're showing the money. And I guess, you know, I've always thought about it that the government basically is saying, you either gonna pay us or you're gonna put down some money. Because if you're willing to, if you got 20% and you rather put it in your house than put it in the IRS, that might be okay. And 20%, let's just calculate that real quick. So if we're looking at maybe a $300,000 purchase, which is currently our market, about that average, we're at about 300 in this marketplace. And it's probably different in your marketplace, but let's just say that we're about that 300. Then 20% is 60,000. 60,000. That's a good number. A lot of people, you know, but then again, if you are, let's say you make 300,000 in income on your self-employment income, and you got to pay taxes, and that's at 20%. That's the same 60,000. So you could maybe now write off things. There are products out there where you can write off. Right? Correct me if I'm wrong.
Exactly. And if you have depletion, you have appreciation.
Appreciation.
Those are things that can be added back.
Oh, depreciation and, okay, that's right. Yes. Mileage too, right?
Well, we don't, it just depends of the lender, I will say.
Okay.
So lenders will let you use mileage, especially truck drivers.
Yes.
But it just all depends on the lender. So you got to be careful with the mileage.
Speaking of lenders, you are a licensed loan officer. Tell everybody you got to do compliance here and give them your license number so they understand we are not just bringing anybody in here. We're actually bringing a licensed loan officer who has been doing this. Give them a little bit more of your background so we...
Sure. Yes. My name is Itzia Johnson again.
Yep.
And my license number is 347895, and I am licensed in the state of Ohio.
Yeah, there it is. There it is. We just want to make sure we're always in compliance and making sure. So now let's switch gears and talk about those who are doing, who are employed. And what are you looking for? And how can we bridge if they change jobs maybe once or twice? Because you know that.
Yeah.
So we're going to talk about that.
Absolutely. With W-2s, it's an easier transition, especially you've been at the job for your 2 years of employment history that we need.
Right.
You really want to be careful when you work for staffing agency. That is the big thing, because you're changing jobs. So you're going from this job because you've been assigned to this other job. So you was at Amazon, then you're a different one. Well, it's not showing stability.
Right.
So what happened is that as a lender, we cannot count that income because it's not stable.
Right.
So you want to make sure that if you're in this process, stay at your job for that 2 years.
Right.
It doesn't have to be in the same
position.
It doesn't have to be in the same industry.
Okay.
So you can be working at McDonald's 1 year, but now you are working at Nationwide Insurance.
Right.
Right? So now you're making more money. So that looks great because you went from making, we'll say $10 an hour, now you're making $20 an hour.
Right.
Even that is different industry, but you still have the 2 years of employment history.
Yes. So 2 years of employment history is critically important, but different industries are okay. And it's different from lender to lender, although there are some guidelines that everybody must adhere to, but different lenders tend to want to put what we call maybe an overlay on things. And so explain what an overlay is.
Yes, an overlay is an in-house lender that we have basically saying we're restricting certain things from our guidelines. Let's say an example, student loans.
Yes.
Okay. So some lender may say, we're still going to use that 5%.
Yes.
0.5%. Another lender may say, it doesn't matter what the guideline says. We are going to use 1% of the amount that you owed. So it just all depends.
That brings up another, we got a few more minutes here. We want to make sure we get it in, but that brings up another big topic because a lot of us have student loans. It's easy to get and hard to get out of. So we have those student loans, and the guidelines keep changing. So here's the deal. It is kind of crazy, right? So they were taking, a lot of us have $100,000 student loans. That means they're going to hold $1,000 against you on your payment. That's going to mess with your debt to income ratio. And you know that is a big part. Briefly, 30 seconds on debt to income ratio. So we can learn from Itzia what that means. What does that debt to income ratio mean?
Debt to income ratio is basically all the debts that you have on your credit report plus your new housing ratio. So combining those two together, it becomes your debt to income ratio. Most lender, we don't want to see that more at 45%. Okay. You're going over 45%. Sometimes we have to go into FHA, which is the other type of loans, and we're going to talk about that a little bit later. But 45% is where you want to be when we talk about debt to income ratio.
Girl, we may have to go over today a little bit. This might have to be just a little bit longer because there's still so much to talk about. And we really don't want to leave people. We want to make sure, we want Itzia to give us that tea. We want to ensure that we get all this information out there. So we might just take this one just a little bit longer. Are you okay with that? I just want to double check.
I am okay with that.
Okay.
I love it.
Here's where we're going with it. You know, sometimes live just goes whatever direction it needs to go in, but we're going to spill this tea. We're going to spill this tea.
Absolutely.
So here we are. The question is, what is FHA? And do I want an FHA loan? What's good about FHA?
It's a lot of misconception about FHA. I'm going to be honest.
Yes.
FHA is a great product because it's federal.
Yes.
It's a federal loan, and it's insured by FHA, which is the Federal Housing Administration.
Yeah.
So what had happened with that is FHA only requires 3.5%, which is 3.5% of the purchase price of that loan.
So let's break
property.
that down. So if we have a $300,000 home and we're going FHA, we're going to need $3,500 for every $100,000. So that means somewhere, if we go to a $300,000 home, multiply that times 3, that puts us at about $10,500 or thereabout. So we are still, that's affordable for a lot of people because they can maybe get those funds out of maybe a 401k.
Absolutely. You can use it for reserves.
Maybe a gift, or maybe they're just good savers. You know, so and then there are all kinds of housing programs.
Absolutely, and the thing with FHA, what they have made a lot of changes. If your credit is good, even if your credit is a 660, you can go over 50% of your debt to income ratio.
Wow.
Some lenders will let you do it, some lenders don't, but I'm just speaking in general. So FHA, if you look at the guidelines, says that you can go over.
Yes.
At least it's a 660, and that is an overlay.
Overlay.
So depending of the lender, they may let you go 50% over at 620 or 640.
Yes.
So it just all depends on that credit score. So it's important to have that credit score as high as you can.
So let's talk about that final piece, that credit score. You know, that tends to be a big problem where we're worried about credit score. What are the guidelines in terms of most people who are going to go out and buy their first home? What should they think about? And are things like, you know, the credit gurus and the credit karmas and the credit, you know, all those Experian and all of that, are they going to give us the real deal, or is there something different?
No real deal.
No real.
But it's a great tool.
Yes.
It's a great tool, and that's what it was meant to be.
Right.
That's what was created. It's a great tool for you to be able to know exactly how much you owe, how much you're paying. You can keep it so in case of fraud, you know, things like that. In case of dispute that you want to do, those platforms are there available for you. But you cannot go by those credit score, because when we pull it as a lender, we're pulling it because we're going to lend you money.
Right.
So it's going to be a little bit different.
Yes.
Sometimes a lot different.
Yes, sometimes a lot different. Sometimes a lot different.
So I'll take that back. Like you can be at 720, and you may come to me, I may give you a 680. And you're
Yeah,
gonna say,
girl, that's
so
different.
how is it that Credit Karma is saying I'm at 720, but now you're pulling my credit, you're telling me I'm 680. What's going on with that?
Well, I'm gonna tell you that I had to learn that, and I have totally been teaching all of our clients, agents, everybody who's kind of a part of our team. We have really drilled down on that to understand that there are different models.
Absolutely.
There are different models, and the lenders choose what models they're going to lend on based on what their how conservative or how liberal their lending patterns are. And to know that is to really keep yourself from having a more challenging experience. When you say you gotta choose the right lender.
Absolutely. You know, you can't have a 620 and still, you know, get financing, but you have to look at how much it's going to cost you.
Right.
Because then having a 620 is not just about your payment and the mortgage insurance and all of that, but your homeowner's insurance will be probably a little bit higher because they do pull credit.
Yeah, credit is important.
So yes.
Well, I have really enjoyed just going through this with you and sharing it with our listeners. I know everybody, I know you got great information today. And listen, we're going to spill the tea. I want Itzia to share with us some takeaways. So Itzia, I'm going to have you wrap it up, and I just want you to spill a little bit more tea here and sweeten it up and make sure our listeners understand what it is. What do you want them to take away with our conversation as we tie this thing up and wrap it in a nice bow?
I will say, don't give up. Have patience. If you have a credit issue, do not worry. Just work on it. It didn't happen. Your credit, it was bad, but now it's good. Yeah. And you know what I mean? So don't feel like you're here alone. That's why we're doing this today. You have any issues with credit, any problem, you want to know the process, we're open here. It's just a great opportunity.
That's what we do. That's what
that's why I'm like all into it right now. So
yes, that's what we do. But thank you so much. Thank you so much. I'm so excited for just making sure that you all get this knowledge. This information is powerful. If you have questions, you know, you can go ahead and place your questions in the comments, and we will respond to those questions and make sure that we continue to give you powerful information that educates you, informs you, and gets you activated. This is Teresa Barron, your host. I will see you on the next one.